6 reasons why most investors should avoid buying penny stocks. Many new investors are enticed by the idea of riches from finding the next hot penny stock, but investing in penny stocks is a high-risk endeavor that often leads to significant losses. In this episode, you will learn 6 reasons why the average investor should invest in penny stocks and what to choose instead to tap into growth. But first, what are penny stocks? The definition of a penny stock depends on who you ask. In general, a penny stock is a stock with a very low stock price. For some people, a penny stock is a stock that has a share price per share of less than $1. However, the Securities and Exchange Commission (SEC) defines a penny stock as a very small company that has a stock that trades at less than $5 per share. The low stock price of penny stocks makes them attractive to new investors because you can buy many shares relatively inexpensively. The thinking is that if the share price rises, you can make a lot of money by owning many shares. The opposite is also true. If the price decreases, you could lose a lot of money too. Now you know what penny stocks mean, so why should the average investor avoid them? Let's take a look. 1. It's a market rife with scams. Google penny stock scams and you'll find no shortage of results. Even the websites that tout penny stock trading as a viable investment strategy admit that scams run rampant. The Financial Industry Regulatory Authority and the Securities and Exchange Commission have issued warnings about penny stocks, specifically about pump and dump schemes. In such schemes, scammers buy shares of what FINRA has referred to as dormant shell companies with little to no business operations, and then promote the stock as the next hot buy. When the price rises, they sell their shares, causing prices to plummet. Remaining investors are left with what is, in many cases, a worthless security. These days, the promotion may come via email or as a voicemail. Scammers frequently pretend they're leaving a message with a stock tip for a friend. It appears to be a wrong number, but the mention of the next big winner piques your interest. This goes for any stock, not just penny stocks. If someone tells you a stock is hot, consider the source and do your own research. 2. Penny stocks are hard to vet. Public companies are required to file regular reports with the SEC, bearing the status of their business through audited financial statements. They're also required to meet minimum standards to be listed on major exchanges, often including a floor for earnings, number of shareholders, and the market value of those shares, among other things. And then there is intense scrutiny from stock analysts and researchers, who quickly bring any blemishes in the business into the light of day. Companies issuing penny stocks may not have to file with the SEC if they hold less than $10 million in assets or have fewer than 2,000 shareholders of record. They're unlikely to be covered by analysts, and while some OTC marketplaces have minimum listing requirements, others don't. All of this can make penny stock issuers very difficult to research and accurately price. 3. Penny stocks can be hard to sell. Given that penny stocks are difficult to vet, who would want them? But if you still do, consider this. You don't make any money on an investment until you sell that investment and realize a gain on the sale. If you buy a stock for $2 and the share price shoots up to $100, an unlikely short-term scenario anyway, that $98 is no more than a paper gain until you sell the stock and pocket the proceeds. Penny stocks bring together the dangerous combination of low liquidity and high volatility. They're often hard to unload because the market for these securities is smaller. At the same time, they can be subject to wild and rapid price swings, which means the price could shift dramatically before you find a buyer. 4. Trading costs can be expensive. The truth is that trading penny stocks can be expensive. Let's say you want to buy 100 shares of 2 companies. Company A is listed at 5 cents per share. Company B is listed at $5 per share. The total purchase price would be $5 for Company A and $500 for Company B. However, you're likely going to be charged the same trade fee for both purchases at many brokerages. Let's say the brokerage charges $5 per trade. In the Company A example, your trading fee is equal to 100% of your purchase price. In the Company B example, the trading fee is only 1% of your purchase price. In addition to the usual trading fees, some brokerages charge an extra fee for stocks valued below a certain price. This adds even more than the usual costs. When you compare it to the investment you're purchasing, the trading fees can be a larger percentage than if you purchase a traditional investment. 5. Lack of company information for analysis. While certain penny stocks may be required to file financial statements with the SEC, not all penny stocks must do so. At the same time, all stocks listed on the major stock exchanges, such as the NYSE, are required to disclose their financial statements. The lack of financial information on penny stocks is a major red flag. If you don't know the accurate financial status of a company, how can you judge if it's worth investing in? Still, people invest in penny stocks because they believe they have a hunch that can make them rich. In reality, they may be investing in a company with no financial statements that's almost insolvent. If you're unsure of your commitment to penny stocks and would just like a good all-round broker, make sure you hit that subscribe button and stay tuned for our future episode covering that topic in detail. 6. Returns might not be as good as you'd hope. Investing in penny stocks usually doesn't end up well for long-term investors. While some struggling companies do turn around and become successful again, others fail. If you're investing for the long term, there's a good chance that many penny stocks you invest in may completely lose their value. This will leave you with nothing. Even when you consider the short term, you may not earn much return from penny stocks. For example, let's say you own 10,000 shares of a company. You bought those shares for 10 cents each. That means you invested a total of $1,000 in the shares. The stock price creeps up to 15 cents, a 50% return on investment, and you wisely decide to sell. That gives you a sales price of $1,500. That initial $500 profit is reduced by your buying and selling fees of $5 per trade to leave you a total profit of $490. While a $490 return is nice, it isn't a ton of money in the long run. If you hold the investment, it could easily decrease in value to 5 cents per share, leaving with a $500 loss. To make matters worse, if you want to earn even more money, you have to invest larger amounts up front. This opens you up to even more risk of losing money if the penny stock you pick decreases in value. So, what should you choose to tap into growth? If the low price is the main attraction here, you should know there are other investments that are similarly low cost but come with far less baggage. We'd steer you toward exchange-traded funds. ETFs track an index, like the Standard & Poor's 500, and hold shares from the companies in that index. These funds trade like a stock on an exchange for a share price, which can be much lower than the typical index fund or mutual fund minimum. That means you can get instant diversification for a small investment. Depending on the ETF, you could buy in for as little as $20 or $30 a share. Like stocks though, some ETFs are priced much higher. That's more than a single share of a penny stock, sure, but here you'll get a stake in a basket of listed, regulated companies. You can also find ETFs at many brokers commission-free, which will save you on the transaction costs that come from a penny stock trade. If you must buy penny stocks, buy cautiously. If you still feel called to penny stocks, at least follow a few rules that can help curb risk. Stick with companies that are registered and regularly report to the SEC. Research the company and its key officers before you purchase. How to research a stock? Simple. Just understand the industry, how the company makes money, and its chief competitors. Train your eyes for red flags. These include financial statements that haven't been certified by auditors or that contain unusual loans or other transactions, frequent changes to the company name or business direction, prior SEC suspensions, and an outsized ownership stake in the company by an office or promoter. Use a reputable broker. A good broker will help you act quickly if you do encounter a scam. NerdWallet maintains a list of brokers for penny stocks. Every investor should invest based on their goals. Consult with a fiduciary financial advisor to come up with a specific plan for your situation. That's it for this episode. Please give us your feedback in the comments section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck, and see you in the next episode.